Hello friends, I'm Satish Kumar. I'll be discussing with you through small videos various provisions in the Income Tax Act. To begin with, let's start with income from capital gains. And in today's video, I'll be talking about the meaning of the term capital gain and also meaning of another important ingredient of capital gain, that is transfer. To put it very simply, capital gain means any profit that is derived from the sale of an asset. Asset can be anything: land, building, property, shares, jewelry, anything. So sale of any of such property would result in income from capital gains. Now let us see what is the Income Tax Act says about capital gains. Under Income Tax Act, Section 45 is called as the charging section for capital gains. That means it is this section which says that the income from capital gain is liable for tax. Now, the essential ingredients as per Section 45 for attracting capital gain is that there must be profits and gains. Of course, without profit, there is no question of capital gain. And this profit and gains must be from the transfer. Transfer of what? Transfer of a capital asset. And this transfer must have been effected in the relevant previous year. Now, if these conditions are satisfied, then it is deemed that the income, such income, would be the income from capital gain of the previous year in which the transfer takes place. If you look at the section, certain ingredients are necessary. One is transfer. There should be a transfer. Then transfer must be of a capital asset. And this transfer must have been effected in the previous year. That means a transfer must have taken place or completed in the relevant year. Now let us examine these words, that is transfer, capital asset, etc. I said there must be transfer and the transfer must have effected. That means transfer must have been completed in the relevant previous year. Now when we say that the transfer is complete, now any asset can be of two types, that is either movable asset or immobile asset or immobile property. And in India, the provisions relating to transfers are governed by Transfer Property Act. Of course, it's a very old act, 19th century enactment passed in the year 1882, but it still holds good. Now, this act says that as far as movable properties are concerned, transfer is complete by handing over the possession. That means, suppose I have a car, I want to sell it, and just give possession, transfer is complete. I need not register the transfer deed with any authority. Of course, the RTO's requirement is entirely different. We're not concerned with that. And as far as immobile properties are concerned, the Transfer of Property Act says that transfer is complete only on registration of the transfer deed, unless of course the property is valued at less than 100 rupees. Now, what is the significance of this 100 rupees? Is because the act was passed way back in 1882. At that time, 100 rupees probably you could have bought some immobile property, but since then this amount has not been changed. It continues even today. In other words, now as of today, every immobile property would be covered by this definition. That means if you transfer any immobile property, the transaction is complete only on registration of that deed. Now, as far as transfer is concerned, let us see what Income Tax Act says. Section 247 of the Act defines the term transfer by giving an inclusive definition. That means the circumstances narrated here in this section are treated as transfer, and in addition there could be some more circumstances also which can also be treated as transfer. Now let us see what are they. First, sale, exchange or relinquishment. Now what is a sale? This is nothing but trading of goods, buying and selling. Okay, so selling for cash, kind, whatever it is. And exchange, that is one item of goods is given away, and instead of taking cash, another goods is taken. So this is exchange. So suppose land is sold and a building is taken, an apartment is taken back instead of cash. Now this is an exchange. Now all these transactions are treated as transfer. And then there is relinquishment. Now what is the meaning of this term relinquishment? It is giving away the right of the owner. Now, owner of an asset enjoys certain rights in respect of that property, like right to enjoy without any interference, right to sell, etc. When I give away my right, it is called as a transfer under Income Tax Act. Then the question may come, what about the gift? If I make a gift, is it taxable in my hands? Now, strictly speaking, yes, when you make a gift also you relinquish your rights in that property. But as far as income tax is concerned, what is necessary is that to apply the provisions of capital gain, I must be able to compute the income from capital gain. Now, how this computation is possible? That is by determining first the cost of the asset and secondly the consideration received. The difference would be the profit, right? So when I am able to compute in this manner, there is capital gain. But if I am not able to compute capital gains in this manner, that means either consideration or cost will have no value, no value measurable in terms of money, then I cannot compute capital gain. In fact, this is the decision given by Supreme Court in a landmark judgment. Of course, a gift is treated as a valid contract as per Indian Contract Act, because Indian Contract Act says that in the case of a gift, consideration is a love and affection. But this love and affection cannot be measured in terms of money. Therefore, income tax purposes, the gift will not be treated as transfer and no capital gains will be attracted. Next section talks about extinguishment of rights. Now, what is this extinguishment of right? That means my rights go away automatically without my doing anything. Suppose I have a car. Now there is heavy rains, lightning, thunder, etc. Now due to the heavy lightning and thunder, the car catches fire and gets burnt out. Now my rights in the car to use it freely or to sell it, etc. Now these rights are extinguished. It goes away. Now, then question is, suppose a property is destroyed like this, whether it is treated as transfer for the purpose of capital gain. Now, with reference to this, the Supreme Court has come out with a landmark judgment. It said such an extinguishment of right must be with reference to or in connection to a transfer. Otherwise, there is no capital gain. To give an example, there are two companies, Company A and Company B. Now suppose Company A merges into Company B. What happens then? The shareholders of Company A, they surrender their shares in Company A, and in lieu of such surrender, they get shares of Company B. Now in this scenario, what happens to the rights of the shareholders of Company A in respect of their shares in Company A? It simply gets extinguished. So court said, now this is a transfer because there is an exchange of shares. So this is transfer, and the rights with reference to shares of Company A got extinguished. So the provisions of section 247 and section 45 are attracted. Then compulsory acquisition. Of course, when government takes over any property for say public purposes, any project, that is called as compulsory acquisition, and of course compensation is awarded, so capital gains are attracted accordingly. And the section also talks about conversion of a capital asset into stock in trade. Now what is a capital asset? That is nothing but any asset which is not meant for sale, which is meant for use by me, either for my business purpose or for my personal purposes. Now when I use this property which was earlier used for either business or personal purpose, for the purpose of sale, at that stage I have converted this capital asset into a stock in trade. That is, any goods which I intend to sell would be my stock in trade. Now this act of conversion of capital asset into stock in trade would be treated as a transfer as far as capital gains are concerned. Then there is maturity or redemption of zero coupon bonds. Now what are these zero coupon bonds? This is a type of bond which does not give you any benefit during the currency of the bonds. You buy at a discount and sell it at face value. The difference is your income. Now for example, a particular bond, say, has a face value of 10 rupees, but this is issued at a deep discount, say at 2 rupees. So during the currency, you will get no interest, no dividends. But on redemption or maturity, it is bought back at the face value, that is 10 rupees. Now what has happened? You have purchased at 2 rupees and you're selling it at 10 rupees and have made a profit of 8 rupees. Now this is treated as transfer as far as income from capital gains are concerned. Then this section also talks about something called part performance, and we will see it in the subsequent slides. And finally, section 2 subsection 47 says that any transaction which has the effect of transferring or enabling the enjoyment of an immobile property will be treated as transfer. So whatever name I give, okay, which results in either transferring or enabling somebody else to enjoy the immobile property, that will be treated as transfer. Friends, I was talking about part performance in the previous slide. Now what is this part performance? Earlier I said, in the case of immobile property, transfer would be complete only on registration of the transfer deed. Suppose I enter into an agreement to sell a property, but I never enter into a sale deed, merely an agreement. So in that case, what happens to my capital gain? Because here transfer is not complete, because transfer deed has not yet been registered. What is registered is only an agreement. So whether I can escape capital gains in such a scenario. Perhaps this issue has been envisaged by the lawmakers, and they have included this provision of part performance in the meaning of the term transfer. Part performance is a creature of Transfer of Property Act. Section 53A of Transfer of Property Act says that when there is a part performance, that is performance in part, not in complete, certain circumstances, transfer is treated as complete. For this, certain conditions are necessary. That first, there should be a written contract. That means that the terms of the contract agreement must be reduced to writing. Okay? And the terms of contract or terms of transfer are clearly mentioned in the contract. Now what would be the terms of contract? Handing over the possession, or the amount of consideration, or the description of the property, etc. They must be very clearly mentioned in the contract. And this transfer is for a consideration. That means gift is kept out of the purview of this provision. So transfer is for a consideration. Okay. And the transferee, so that means the future buyer, in part performance, in pursuance of the contract, takes possession of the property. That means the property must be handed over. Possession of the property must be handed over. And after taking possession, the transferee must do something as per the contract. What is the meaning of this doing something? That means after taking over possession, suppose there is an agreement between two persons to develop a piece of land. So the buyer or the builder, after taking possession, now in the case of immobile property, how property is taken possession of? By showing that he is the current owner. That means either he puts up a fence or puts up a board saying that the property belongs to so and so, something like that. So he has taken over the property and it does something in pursuance of the contract, like say clears the land or starts construction, something. So he does some act as per the contract. And more important is he is willing to perform his part of the contract, that is payment of consideration and say maybe putting up of the construction. So if these conditions are satisfied, such a transfer will be treated as a valid transfer even though registration does not take place. Okay. Here what has happened is there is an agreement. Generally in the case of lands, immovable properties, it is called as a joint development agreement. Okay. So there is an agreement. There is no transfer deed as such. So there is an agreement. Maybe it's registered or not. But without registering the transfer deed, normally the transaction is not complete. But here it is treated that the transaction has been complete by virtue of Section 53A of Transfer of Property Act. Thank you, friends.